Good afternoon, ladies and gentlemen, and good evening to those who have joined from Far East. Thank you for connecting and welcome to National Development Bank PLC's quarterly investor webinar, where we will be discussing the financial performance of the bank and the group for the financial year ended 31st December 2023. It is my pleasure to introduce to you NDB's newly appointed Director and CEO, Mr. Kalu Medrisinghe. Today's webinar will follow the same format like our prior webinars. Callum will start and take you through a prepared presentation. At the end of this, we will commence the Q&A session. The senior management team present here will be accessible to you during the Q&A session. Participants can raise questions using the chat option and they will be taken up by the panel. We please request all participants to remain on mute throughout the presentation and during Q&A. Chat option will be enabled only at the commencement of the Q&A session. Thank you again for your participation. And I now hand over to Callum to take the presentation forward.
Thank you, Bimal. Good afternoon to everyone who has joined our investor webinar. Really happy to be here. I joined NDB on the 1st of February. So far, loving the job. And I also want to warmly welcome the senior team who's here with me today. I have KV Vinoj, my Deputy CEO, Sanjay Pereira, Senior Vice President, Personal Banking, Hasida Atapattu, Vice President, Finance, Niran Mahavatta, Vice President, Treasury, Bimal Pereira, Vice President, Strategy and Business Intelligence, Indigo Ranavir, Vice President, SME, Middle Market and Business Banking, Ishani Palliguru, Vice President, Project Finance, Zian Hamid, Vice President, Branch Network Management, Alex Pereira, Vice President and my CRO, and Damita Silva, Assistant VP, Product Lifecycle Management. With that, we'll proceed on to the presentation. As Bimal said, we are going to follow the same format that will be covered in 4 parts: operating environment, financial performance, the way forward, and then we'll have some time for the Q&As. So when you look at the operating environment, I think there is a good story here. When you look at the GDP is showing a positive trajectory. The latest 4Q results that were released a couple of days ago shows that the economy has expanded by about 2.5%, albeit on a lower base. But if you look at from a year-on-year perspective, the economy actually still remains at a contracted level. On the inflation front, it is slightly more a positive note. Looking at January 23 to now, inflation has come off quite significantly from the highs of maybe 50, 60s to when it settled down at 4.2 in December. But if you look at the more recent numbers in January 24 and February 24, January showed a slight uptick of 6.4%, and it slightly softened in February at 5.9%. But when you look at the near-term trajectory, it is likely that inflation will remain slightly ahead of 5% of the policy target, largely as a result of the recent tax adjustments. But on the way forward, we expect that to sort of fall within the policy trajectory. On the exchange rate, I'm sure most of you would have been following the performance of the rupee. If you look at the year-end, December 23, it ended at around 326 versus 360s in 2022. But if you look at more recent data, as at maybe today, having dropped below 300 yesterday, it has now settled at around 300 rupees. And that is driven by primarily 3 things. We have seen strong remittances for the first 2 months to the tune of about $960 million, up some 14% compared to the previous year. Tourism has raked in about $687 million, up about 118% compared to last year. But I think the overarching theme here is that the demand is subdued, and therefore, exchange will continue to remain at this level until the economic kind of picks up. On the interest rate front, driven by the policy changes, which we'll discuss towards the latter part of the deck, we are seeing a significant reduction in rates. And in December, AWLR has settled at around kind of, 12.9%. But if you look at more recent data, we are seeing that now settling down at about 11.3%. On the operating environment, there are a number of changes that has taken place in the recent past. And if I'm to kind of pick up on key things, central bank has reduced interest rates by about 650 basis points. And along with that, we have seen the lending rates coming off. And that has given some boost to the lending side of things. But again, as we have seen on the GDP front, it is yet to come into sort of the full force. But generally speaking, we see green shoots ahead. On more specific data, sector assets have grown by about 5.1% in year on year, but loan has actually contracted by about 2.6%. On the credit quality front, we do see some stresses, but it is at a moderate level. So we don't necessarily, at least for ourselves, don't see major shocks in the year to come. And generally speaking, the whole sector has sufficient liquidity, and I think in that regard is in a good position. With regard to the financial performance, I think it's fair to say that this is a good report card compared to what we saw maybe a year ago. Gross income is up 20%. PBT is almost 300% above history at almost at 11 billion. And group PAS is at around 5.8 billion, again, 91% up. And the other key ratios are also very healthy with strong capital and liquidity levels, which we will discuss in more detail in the slides to come. To sort of dive a bit more deeper into the financial performance, so we've seen compared to 2022, our gross income increasing by 20% to 132 billion. And along with that, net interest income outperforming 2022 at almost 32 billion, about 4% up. I will not go line by line, but I just want to sort of drive the key messages there. We remain very competitive on our NIM side, despite the falling interest rate environment at 3.96. And that's largely thanks to taking proactive measures on repricing both our assets and liability book, which we will continue to do in months and in the months to come. On the revenue composition, we've seen a marginal improvement in non-fund-based income, resulting from dynamism of our key revenue streams. So those are the key points that I want to highlight on the financial performance side. Coming to the impairment sort of changes, and I think this is probably something that might be of interest to most of you all. I think the key message here is that compared to 2022, 2023 show a marked improvement with impairments coming down by about 30%. And that is, in fact, what helped us to drive deliver a strong bottom line performance, for which I'm very thankful and really proud of my leadership team. So along those lines, we're seeing kind of changes in the impairment distribution. So if I'm to pick on the ISB or the financial assets front, 2022 we saw a booking of about 17 billion rupees, which has now resulted in a reduction of 5 billion rupees, because I think we have already built sufficient impairment buffers in previous years. On the loan front, we want to take a more prudent and a practical approach, position ourselves to cover any downside risk. And we looked at on a BAU basis, improving our impairments, and that settled slightly below 16 billion. But that doesn't in any way say that there is anything to be worried about. We are pretty comfortable with the quality of our book. And along with those changes that we have done, we have seen our impairment cover on the loan book increasing to about 8.75% compared to 5.81%. And also along with that, our impairment cover stage 3 loans to 41%, up something in the region of 400 basis points or slightly below that year on year. So that basically underpins our conservative approach and the views that we have taken in terms of having the appropriate level of impairments on the book. On the operating expense front, again, a good story, and overarching theme here is that despite increases in the operating cost, we still remain a bank with a very healthy operating expense ratio at 30%. And I believe we are around among the top 3. But if you dive into the more specific ones, the personal expenses, it's up by 17%. That is largely driven by salary expenses and variable pay with the adjustments that we have done in 2023. And the other most notable increase actually comes from other expenses comprising of premises, energy, and IT infrastructure. But overall, we have been able to keep our total operating expenses at around 20%, which is commendable given the challenges in the operating environment. On the profitability and taxes front, so this again is flowing down from the performance of the top line and the bottom line. So maybe a couple of key matrices that I want to speak to. Operating profit before taxes compared to 2022, 23 is up by almost 400%. And along with that, profit for the period is up 85% to 5.3 compared to 2.9 billion the previous year. And if you look at the line below that, profit before taxes have settled at just a shade below 11 billion compared to 2.6 billion previous year. And perhaps one other point to note is if you look at the tax regime, banking continues to be one of the highly taxed industries, paying above 50% to the government coffers. And that has actually come as a result of changes in income taxes by about 6% and addition of SSL 2.5% in 2023. Looking at the balance sheet structure and its composition, compared to 2022-23, if you look at the asset figure, it shows a decline, and so does our loan book and the deposit book. And point to note here, which is already covered in the narrative ways, this is also largely driven by 2 things: rebasing the recalculation of the balance sheet at the current exchange rate. In 2022, dollar rupee was at around 367. And when we closed the year in 2023, it was around 324. So that impact, and of course, to my previous point that I discussed about loans having getting impacted due to subdued market conditions. On the currency composition, we are fairly well placed. Bulk of the book being funded by rupee loans and rupee deposits, but most notably our foreign currency loan book is well funded through our foreign currency deposits with sufficient buffers to withstand any shocks should there be one. So moving on, I think in terms of the key investor ratios, we are seeing good momentum in the share price. It did pick up to about 66.40, I think, during the day, and I think it has slightly settled at 66.10. If you compare this with a year ago, it has almost doubled, and I think that's a testament to what the firm has done to drive bottom line performance and the general sort of confidence level. ROE is at 8.3, again, up from 4.75, and price to book value has also increased to 0.4 compared to 0.19. It's well understood that on some of the matrices, particularly on ROE and price to book, there is a bit more work to do. And that is one of my objectives and goals to drive that through sustainable and accretive bottom line performance. And I'm confident that we will be able to sort of improve these ratios with a strong performance in 2024. On the capital and liquidity front, the narrative actually continues from 2022. Our minimum capital requirement is well above the 7%. And again, Tier 1 is at 16% versus the minimum requirement of 8.5%, and total capital at 15.9% compared to the minimum requirement of 12.5%. Again, a marked improvement compared to 2022. So the underlying message there is our balance sheet is well capitalized. We have sufficient liquidity, and we are in a very good position to capture any growth opportunities that comes from the pickup of the economy in 2024. So it's a good position to be in that regard. So when it comes to 2024, there are a number of things that we are looking at. We want to drive the loan book growth aligned to our economic revival, and really, to the point that I made previously, focus on bottom line, create shareholder value, and improve the value of the firm. Looking very consciously to manage NIMs, and that is that's going to be achieved by way of really garnering low-cost deposits, by widening our deposit base, and also looking at repricing opportunities in the asset book. Needless to say that preserving asset quality and improving stage 3s is a top agenda. We're putting all our efforts to manage the stage 3 book, and in fact, the recovery unit is directly under my purview. So it's getting the necessary support and attention it needs to revive the accounts, do the restructures, and give solutions so that the customers can come out of their financial difficulties. We're also looking to maximize our fee-based income and enhance revenue streams. So there are a number of initiatives that we're looking in that regard. Capital structure is also an area that we are looking to sort of further strengthen. We're looking at augmentation plans when the market conditions improve. And I'm sure you would have seen our recent announcement for a debenture issuance of 10 billion rupees. So we will be seeking, we have actually received in principle board approval, and it'll go to an EGM for ratification. And raising of the capital, we look at when the market is most conducive for us. We will continue to drive our digital experience and make it easier for customers to bank with us. In that regard, we are again looking at our digital apps, the NEOS, for both both for personal banking customers and corporates. So there's some work that is being done, and it'll see its features being enhanced in the near term. Supporting and empowering women workforce, it is one of our key strategic pillars. In fact, NDB had its Vanita Abhimana, a program that we run together with News First on the 8th of March, and it was a resounding success. And we will continue to give prominence to the women workforce, give them a platform to be recognized, and support them to make a bigger contribution to the economy. So that's the presentation I have for you today. And I think we can now move into Q&A session. And I will also look for the support of my team to pick up any questions that you may have. Question is, between Jan and March of this year, has the bank increased its balance sheet stability? The short answer to that would be yes, and I'm assuming that you are asking this question based on the impairment numbers and so on and so forth. But if you really sort of look at the capital side of things, and that actually shows that our capital is in a good position. We have sufficient liquidity, and then we are well positioned for that. So it's a question on where and when the interest rates see the movement. Perhaps I could ask Niran to pick up that question and give your views, Niran, from the market side.
Actually, we have seen during the last couple of months or the 3 months, the treasury bill rates are also coming off from the high levels and falling in line with the policy rates. So we feel, but looking right now, I think there's only about a little more room for rates to come off. I doubt that there'll be significant rate cuts going forward. probably we might see about another 50 to 100 basis points rate cut from at policy level over a period of time. So there may be a little bit of more room for interest rates to come down from the current level.
Okay, so there's a question on, given you have sufficient liquidity in US terms, will you be opting to accept the ISP restructure, at least partially in LKR terms? So this, of course, depends on the restructuring proposal the government would put forward to the bondholders. So there are a number of discussions taking place in this regard, but we haven't seen a formal proposal. So when a formal proposal is put on the table, and we'll obviously look at that as a group of bondholders and look at what is that we could accept, and at that point we'll make a call. So there's a question on how is the pricing going to be on the corporate debenture. Niran, do you want to sort of give a view on that?
We are still not finalized on the rates and all that, because the timing will really, because we have not really agreed on the time plan there. So once the timing is fixed, the time that we go into for the market, then we will decide on the rates. Also looking at the possible rate movement, downward rate movement also towards the second half of this year.
So there's a question, has there been any movement of the usage in credit scores in the loan appraisal? So we are not seeing a significant movement, but where there is a requirement for us to take a judgmental view on some of the credits, we have done that. And that is going to be a BAU process in our credit appraisal process. But as far as the scores are concerned, we don't see a significant movement. On the interest rate front, I think there's a question is, has a lower interest rate being passed down fully to the lending, and how it's determined for your loan growth? I think the point to note here is that if you really look at the interest rate, the trajectory, that has actually been passed down to our borrowings as well, and that's reflected in our rates. But we need to also be cognizant of the funding of the loan book actually comes from the deposits. So there needs some time for the deposits to reprice as well. But in general, yes, we have passed down the reduction of rates. So there's a question on in January, private sector credit growth reduced by approximately 50 billion. Did the bank witness a similar trend? And do you feel this is partly to the currency impact? Also, what is the outlook for growth for 2024? Yeah, I think good observation, and I think that is quite common across all the banks. We are also seeing something along the same lines, but that is also partly driven by the exchange impact. Needless to say that growth will have to come from along with the economic pickup, and we are confident with the numbers that we are seeing on the GDP side, and with the interest rates coming off, the environment would be more conducive for consumption to pick up, and there have to be loan growth. Okay, there's a good question on, can you comment a bit on the Parate freeze and how you see that playing out? Yeah, so I mean, this has been widely discussed by the industry, by the central bank, and its impact. So for a bank, we need to have access to the required legal framework to operate in an environment that could, where we could protect both the shareholders and the depositors. So removing of the Parate action is, something that actually I think is going to be detrimental to the banking sector. One of the unintended outcomes of that could be where banks take a more cautious approach in lending, and therefore the credit growth is hampered. So we have, as a group and through the Sri Lanka Bankers Association, we have made a number of representations in this regard, and we believe that at some point it'll be reconsidered, and it is also really important that that is protected, so that the banks can go on with its normal course of business. Not to mention, of course, removal of the Parate or a prolonged suspension would also impact some of our loss modeling sort of assumptions, and that could also lead to value of collateral being understated but is diluted, and therefore having to take additional impairments along those lines. So we are hopeful that that Parate freeze would be reconsidered, and that will be brought back as it was before. So there's a comment on, please confirm I heard correctly, NDB is going on a debenture issuance. If yes, please advise tenor, structures, timing, and the book runner. Miran, do you want to?
As I mentioned earlier, I think we have not yet decided on the terms of and then the structure of the debenture. So I'm sure after we get all the regulatory approvals and all that, and also at the time that we are going to go into the market, those announcements will come in. So right now we are only, it is only at a very, very pivot level that we have not yet to decide on the conditions and the terms.
I think there is a comment on whether you could predict the LKR USD rate, and I'd be like to hear that.
But basically that we have seen a significant appreciation in the currency, almost about 7% during the last 3 months. So we feel that this trend may continue for at least in the short run. And I think the central bank is doing a very good job by absorbing as much as possible. I think they bought almost around $280 million for the 2 months. And also I'm sure they have picked up about a substantial amount for the March as well. So we might see this trend continuing for in the short run until the import demand kicks into the market, and also once we start repaying some of the bilateral loans and some of the other instruments. But I think we have heard that already some of the credit lines have been started taking payments are through, including ACU payments. So so the pressure can come in, but in the short run, I think there's still more room for the currency to appreciate.
Yeah, and there's a question on what kind of impact NDB would have due to the suspension of the Parate till 2024. So it's difficult to give a financial quantification on this one. Although it was debated, it was not passed into law. So obviously the action was in flight. And I think it is important to reiterate that banks, all banks, I mean, including NDB, would not look at Parate as the first sort of get out card. We exhaust all our recovery efforts, and Parate is only considered as a last resort. To that extent, we always discuss with clients, and we have our remedial management unit and the recovery unit who puts out practical sort of debt restructuring solutions, and Parate is looked at only as the last option. So of course there would be an impact, but given how we look at under the restructuring credits and putting solutions to customers, I think there's not going to be a material impact. But I guess the bigger challenge is going to be if it's removed altogether, or if there is a prolonged delay. So therefore, the ask from the banking sector has been to bring it back as early as possible, so banks can continue to sort of operate the way we. So there's a question on CRIB data published by the central bank says NPAs may increase in 1Q24 for the banking sector. How do you guide analysts and delinquents of the bank in the near term? So I think if I'm to talk about NDB's position, I'm fairly confident that we have got the credit quality well under control with what we have done in 2023, and having the remediation unit in place. Of course, I think the outlook of the economy is going to be a key factor, and for businesses to revive and sort of come back online. But again, there will be some breathing space on the interest rates front. So in terms of the outlook for ourselves, at least we don't see we are not expecting a major shift. And in fact, with some of the work that we are doing already, we hope it to be remain largely flattish or to improve. So there's a question on how has the demand for import credit been in March pre-out, then how does it compare with previous year? Vinod, do you want to pick this up from the wholesale side?
Yes. So I think January was very strong. I think we saw a very high demand on the trade book in January, but February and March, the demand has been muted. I think we anticipate until Aurudu, this trend will continue. Maybe just post Aurudu, maybe we can see once the exchange rate also stabilizes, maybe the trade will pick up. But Jan was strong, February and March, the demand was very muted.
Okay, there's another question. How has the demand for import credit been in March? Vinod, I think that's the same answer that you gave before, right? So the question is, isn't the CBS the entity that has a right to determine parata action? Doesn't this go against IMF conditions of CBS? CBSL's independence when the cabinet interferes with the CBSL act secondary objective of the financial stability. Look, a great question, but as we all know, it has now been brought before the parliament, and all the laws are or changes to it can be done at a parliamentary level, and then that is the outcome of this. So we would, again, going to my previous comment, the expectation is that to be sort of brought back so that banks can look at its lending strategy independently without having to be concerned about the quality of collateral and the enforceability of that. So there's a question on government plans to form a development bank by shedding private bank stakes they hold. Has there been indicated any timeline for selling these stakes? No, so of course, this was mooted. And I think if you look at some of the IMF diagnostic comments, that they have also referred to government stakes in private banks. But as far as information available now, there is no clear timeline given for the implementation of the development bank, although that has been mooted as a way forward. What is the timeline for implementing the tier 1 single borrow limit? Do you know, Hasita or Bimal, can you pick that up? Or I think maybe the question is, I don't know, that's on the single borrower limit. Oh, Alex?
So this regulation still, I don't think it was in the draft stage. 2 drafts have been circulated, and the latest indication we got from the regulator was that it is going to come in very soon. Still, it has not been published, so we are waiting for the direction on that.
So there's a question on why can't NDB play the development banking role given your past experience in this? In fact, we are, and our development banking project financing arm headed by Ishani is doing extremely well. And that has been our forte, and we continue to play that role. And in fact, one of the forward-looking objectives which I mentioned with regard to the asset growth is also partly coming from the project financing arm. So that will remain an area that we will be keenly looking to grow, depending, of course, on the opportunities and the opportunities that are going to be available. So there's a question on what are your plans on NIM. So obviously, with the rates coming off, this is going to be a bit challenging, but regardless of that, we have done well. Actually, the team has done well to look at broad basing our deposit base so that we can attract low-cost deposits, as well as looking at asset pricing based on our RORAC model so that the risk is priced appropriately. And that is going to be one of our key drivers in 2024. So those are the 2 primary levers that we are looking to pull to keep NIMs at a healthy level. So the question is of, if the single borrow limit is to be implemented soon, do you expect the banking sector to carry out right issues, or is there an alternative way, like a hybrid instrument to raise tier 1 capital? So the single borrow limit, if you look at it in a broad scheme, is the expectation is to limit concentration risk to entities. And I believe in a more developed form, there is, what they're looking to achieve is the capital market fundraising through capital markets. Again, for the single borrower limit, there is a bit of a glide path. And banks are given a bit of breathing space to look at their clients and how that can be funded. But obviously, where there is an opportunity to raise capital and finance that, banks will do that. That's true for ourselves. But it's more in terms of broad basing the lending and sort of spreading the risk across multiple banks and looking at other alternatives to borrow money from capital markets. So there's a question on how is your asset liability mismatch during the next 12 months look at. So if you're looking at it from an AD ratio point of view, I think we are well positioned. I think as I spoke to some of the liquidity matrices, we have enough liquidity, so that's not an issue. And in fact, there is a bit more room for us to lend, in fact, and those are the opportunities that we are looking for in 2024. So I think we may have come to the end of the questions. Maybe we'll just give another minute or two in case if anyone else has any more questions, given that we have a bit more time. So there's a question, how are you doing in terms of staffing? I guess this is about recruitment. The number of resignations in general has plateaued, so we don't necessarily see the level of attrition that we had previously. So that's no longer a concern, and I think we are fully resourced now. So there's a question from a risk assessment point of view, what are the key strategic changes you are proposing for NDB in the medium term? Look, it's fair to say that our risk assessment and the risk culture is well embedded in the organization. Of course, we look to sort of refine it through data where possible. So that remains one of my strategic objectives as well. So we look to sort of look at market data points and talk to people who are good in model development to refine our risk culture and the risk assessment. So that's a pathway that we intend to plan. Although at this point, don't have anything specific to share, but we will continue to look at that as an area that could be improved perhaps. On the loan book growth, what are your expectations? Do you think it will be subdued till elections in October? Also, when do you expect the ISC restructure to be finalized? So maybe I'll ask the second question first, and I'll hand over the loan book question to my colleagues from wholesale banking and retail banking. So on the ISB restructure, there is no firm date as yet. We hope that the discussions and the negotiations would proceed swiftly and a finality is reached. But we'll have to wait for that. Maybe Vinod and
So on the loan book, I don't think the expectation is not to wait till the election. I think we have already seen the demand coming in. Probably why you won't see that in maybe the first quarter is that the deals are still maybe on the initial stage. Some projects have been initiated. I think we are talking to the investors, talking to the clients. So probably that's maybe the delay. But I think well before the elections, you will see the loan book growing. I think especially on the wholesale and project finance. Retail side, probably Sanjay maybe can add, but I think that it'll be again a cautious growth. But we haven't seen huge demand coming in. But again, we have seen some demand on the housing side. Probably Sanjay maybe can add retail.
Yeah, as Vinod said, there is a demand in specific products. We are cautious. However, we see a demand now coming in with the interest rates coming down. So stabilizing their debts with lesser costs. So there is a demand, and we continue to grow that space.
So there's a question on, is Vanitha Bhimana a continuing initiative? So we have done it for 4 years, and it has been extremely successful. It has given a platform for some of the women folks to come to the limelight and to be recognized. That remains one of our key strategic pillars. Our hope obviously is to continue that, and even give more opportunities to female cadre to contribute to the GDP. So that definitely is one of our objectives. There's also a question on what is your impairment coverage with collateral. So if you saw, I think our stage 3 coverage ratio has improved about 41%, and we are one of the banks that has a good amount of collateral. All put together, I think we have sufficient buffers to look at any to withstand any downside risk, and that's something that I'm extremely comfortable with. On our specific industry NPL, so look, I mean, if you look at, we are not no different to the general banking industry, and looking across the country and the challenges that the industries have faced, it's primarily on the tourism side, and there is, of course, on the SME side as well, and that is because those sectors are impacted. So I mean, in NDB's case, it is not any different to the general sort of banking industry, but the broader topic of the broad comment that I have is that with the necessary sort of safeguards that we have taken, I don't necessarily see a challenge in managing the NPL book that we have now, or any industry that we have not identified as a hotspot. There's a question on what's our view on assessment of NDB's cost of capital. Yeah, so it's an internal ratio, and I think it's at a manageable level, so not something that we are concerned about. So there's a question on, with Q4 GDP growth being much higher than forecast, do you foresee significant impairment reversals? I don't think it's that linear. Obviously, GDP growth will help businesses to come back online and then perform. But I think what we want to be cautious is that whatever that we do, we don't do it in a haste, in a manner that is, perhaps too early. So impairment reversals, if they were to take place, that is either as a result of debts being paid down, or the customer being offered a robust restructuring plan, and having and going through that restructuring plan and showcasing that they have the ability to repay, and that being validated by 3-6 months of repayments. So that's how we look at our impairment reversals trajectory. All right. I think that's it as far as the questions are concerned. Thank you for your participation at the investor webinar, and thank you to my team who's present here today for taking your questions, and more importantly, for their contribution in 2023 and keeping NDB safe and generating strong bottom line performance. I look forward to your support as an investor community, and I look forward to the support of my team to even do better in 2024. Thank you.